Hello, everyone. Hope that you had a wonderful weekend. I'm pretty sure that some of you had a good trading day today, as one of the few models that I've been, teaching you guys, without you basically knowing that I am, which, I will, make loud and clear right now. Right. So, anyways, before that, today you can see that we have no, high impact news events. And this will be how we will be going forward, right? If there is no high impact news event on Monday, then the live stream will be Monday afternoon. But if we have news on Monday, then we'll do it on Sunday, right? Because there is no reason for us to be doing anything in the market on Monday unless what happened today happened. What happened today? There was a correct correlation between Friday, the past Friday, and today, right? So there was sequential SMT or SSMT between last week's high or Friday's high of last week and the high of the day today, right? In regards to the S&P 500, NASDAQ, and the Dow Jones. So tomorrow we have high impact news events at 8:30 and 10 a.m., right? So tomorrow will not be the best day to trade. The best day to trade will be Wednesday. Obviously, we all know this. It's CPI, and that's when we should get most of the volatility, right? So tomorrow, people usually say, do not trade the day before CPI or whatever, but as long as there's a setup, right, you can take it, right? Due to the fact that I'm pretty sure that most of you here will not be risking all of your account on one trade, right? On Wednesday, as I just said, there will be CPI, so we'll have a lot of volatility entering the market. The market will become one-sided, right? So after CPI is released, right, if you manage to get in, that's fine. But if not, the market should be, going in the same direction for at least a few days, right? So there will be a sentiment shift, and that is what usually happens on CPI, right? The market usually builds volatility on both side, buy side and sell side before that, which, is something that is evident when looking at the interest rate trials, right? On Thursday now, it will be, pretty straightforward. If the higher low that, formed on the day of CPI is run out and there is sequential SMT, there will be a trade, right? We will be monitoring these things closely this week, right? Monday, if you did nothing today, then, you should be looking to do something come tomorrow, Wednesday and Thursday, right? Pay attention to the markets, look for what we talk about, and I'll be here to, highlight those things. And of course, as I've said before, we will be here 8 a.m. sharp on Wednesday, right? So we will be here monitoring the market before Wednesday and studying what happens to the marketplace before and after CPI is released, right? So that one will be a bit lengthy, won't be a very short live stream. Here on my screen, you guys can see that I have the index futures charts up, right? And last week, you know that we have been on point last week, right? When it comes to the index futures triad, right? So first of all, when price was here, and let me get across, right? Literally here, right here on this candle, right? This is when we had the first live stream of last week, right? So we expected price to just go up, right? We did not expect price to fall back here into this fair value gap, but there's a reason for that. right? We just expected price to go up. And, before going forward with what I have to say, why didn't we expect price to fall within, below into this fair value gap? This is due to the fact that the week prior to this, right, whereas we had the bottom form here, there was SSMT, price traded up. There was a fucking correlation between the gaps right here, right? Right here. So we had this gap right here, which all of it in its entirety was formed below this high, right? It was all formed below this high and below this gap right here. So hopefully, and if you don't get this, we will obviously be talking about these things over and over and over again until you do, right? So here, right here, we have this gap, and this isn't even the main reason today. It's just us doing our analysis, talking about what we expect of price, the main pools of liquidity that could trigger a reversal if price runs through. That's the main thing for today. Anyways, here, right? So we have this gap, right? 1, 2, right here. Let me do both of them. Right, so on the left side of the curve, right, we have 2 gaps, right? On the right side of the curve, right, we have 1 gap below the second gap. There is 1 gap, right? So this gap is in the middle of these. Here, we have 2 gaps on the sell side of the curve. I'm trying to do this so I don't, take up too much of your time with this simple thing, right? 2 gaps on this side of the curve. Here, there's 1 gap. Here, right, looking at the Dow, we have 2 gaps. On this side of the curve, and here, how much gaps do we have? Here we have 3 gaps. So this in itself is showing a cracking correlation of the sell side and the buy side of the curve. Right here, as you guys can see. Right? So here, there's 2 gaps here, there's 2 gaps here, there's 3 gaps. So here, when we have the 3 gaps here, you don't really have to pay attention to the one in the middle. But this alone shows you that something is out of order, which equates to a cracking correlation or a upcoming shift of sentiment, right? The liquidity here is unbalanced. The liquidity here, the gaps were made and left this way on purpose. This is not random, right? However, here, where we have this gap form on the first gap to form on the buy side of the curve, the formation of this gap was completed above all 3 of these gaps. So even if there was just 2, and the highest gap on the sell side of the curve was, overcame by the first gap on the buy side of the curve, this would, indicate that we would be going higher. We will not be falling back, into this gap right here. Also, we had, sequential intermarket sequential SMT right here, and sequential SMT between the wicks, right? So this is one of the reasons why, and I just answered the question, why why didn't I expect the price, to fall back within, this gap right here is because of this right here. Also due to the fact that even though we had all of this happening here, we had price closing above this high, right? Price closing above this high. Here, right? This high right here in regards to the, index futures trade, and no, I'm talking about the NASDAQ right here, right? The NASDAQ. So this gap right here, and let me use the cross, right? This gap right here, on the closure of this candle, that's when the gap was, instigated. This is the candle that, had price, telling us that this would be a fair value gap. So even if when we had this candle right here close below here, and this one closed below here in regards to the S&P 500 and the Nasdaq, and then we had this candle in the Dow closing above all of the gaps on the sell side of the curve, then even before the formation of the candle which occurred, afterwards, we could expect that this would be a gap already, even though it was not a gap yet, if you understand. But we could expect that this would already be a gap due to the closure of the candles in regards to the inefficiencies on the sell side of the curve. So anyways, right here, right? And now let's talk about the NASDAQ, right? So here, look, and where my mouse is, right? So here, we expect the price to just go higher. And now look at the Dow here. What do we expect? Just higher prices, higher prices, higher prices. Here, what do we expect? Higher prices. Did we say we expect price to pull back? No, we did not say we expect price to pull back, right? We just expected higher prices. We expected the Dow to take out a certain pool of liquidity. And due to the fact that the Dow, was supposed to go higher, then everything was supposed to follow. Also, right, during the center of the week, where we had price, pull back a bit, right here, right here, we had price pull back a bit. Was this bearish? No. Why not? There was no cutting correlation here. So, as you guys can see, right here, right, this high right here that formed was not taken, by any of the candles prior to this one right here. So price dropped. And once you see this happen, price drop here, and then right here, there is no, sequential SMT which caused price to drop, then you should know that we will be going higher. Right here, we had price drop. And right here, and I'm going to zoom in right here, right? So let's go to the 1 hour time frame, which is what we use when we are studying the weekly cycle, which is comprised of days. So right here, right, you can see this, right? We have a higher low here, and again here, we have a higher low again, and then here, we have a higher low again. So by looking at this, like, what would be the reason you say the price turns where it cracks? There is no cracking correlation here, right? There's no cracking correlation here. That's, what the regular person would say. But there is intermarket SSMT, right? And we'll get to that. And that is the main reason why during the live stream, which, you can watch over again, and we'll be attempting to, have that accuracy live, again, right? We won't be perfect, but we will be right more times than not, right? So when price was literally here, and we were on the minute and the 5-minute time frame, I believe, right? Here, it was here on this candle right here. Well, price was literally trading down, right? Literally this candle right here, and we're looking at the S&P 500, and that was the asset which I was focused on, right? So when price was trading down on this candle was black. What do we expect? Higher prices, right? That was what we expected. Did we expect price to go above here and reverse? No. Did we expect price to go above here, then turn? No. We just expected price to go higher and higher and higher and higher for the remainder of the week, right? So here you can see that there was about, let me see how much points for the week. Am I reading this correctly? This would be how much? 56 points. Yes, 56 points, right? Which is decent, right? That's decent. Throw just one contract in that, it's over. You're good. So, and we got this right here, this move. And first of all, everything that we talked about before, led to this going in this direction. But the main thing which, gave this away, which is why I literally came live and I was just like, here, higher, 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 higher. And you could hear in my voice, there was just, almost this sense of cockiness, which is not something that I like about myself, but it was just, me having no fear, talking here that, someone's going to record it and then post it and then days wrong, it was almost certain, right? And this is one of the reasons why I say that Thursday is the best day to trade, right? Thursday is the best day to trade, in my opinion, right? So you should already know, right? Thursday's model, every day has its own model, right? Thursday's model and Monday's model, which, played out today, which we will talk about soon, right? Over here, let's go back here, right? Here, the 1 hour time frame, let's go to the interest rate chart, right? 1 hour time frame. And we be looking at this. So first we're going to look at this. And we can literally just use one of them, right? Which is the T-bond futures. Due to the fact that the only, reason why we even look at this is just for, a confirmation, right? This is the only reason why we look at this. We look at the bond market or the 10-year note or the 5-year note is just for confirmation of our sequential SMT, or, just to see a crack in correlation. So here, and I'm just doing this right here, right? And we'll look at the crack in correlation which occurred between the index, futures market, and the forex market afterwards as well, right? So this could be confusing to some people, right? Whereas here you can see that there was not a significant low, right, on Thursday of last week, which could lead to a rally, right? But I'm showing you this right here to show you that the only thing that matters is the closures, right? So whenever you have something like this, you should not, be confused. So the lowest close right here, where would it be? It would be here, right? Right here. And that is not showing as bright as I would like it to. So let's use, what should I use? I'll just use this, right? So that's this right here is the lowest close of Wednesday. What you need to understand is that as long as, right, the close here is lower than this close right here, that there's a cracking correlation. You know, given that it is supported in another market, right? So it doesn't matter if prices ran through low. Even if the close here, right, we have this close here, but here we had this one, being the base of the failure swing, right? So here we have Thursday, here we have Wednesday. Thursday failed to break below Wednesday's low, whereas even earlier in the day, right? Looking at the S&P 500 right now, we had price above this low. Earlier in the day, we had price below this close, right? So here, when we see price just trending lower and trending lower, right? Below the low of, way below the low of Wednesday, right? This is Thursday. Way below the low of Wednesday, we should be expecting what? Higher prices already. We should be seeing this as price searching for, a bottom, price searching for support, right? So here we just had price just continuing to melt, right? Just going lower, going lower, going lower. Whereas here in the S&P 500, where were we? We were above this low, which was the low of Wednesday. So we should literally be anticipating higher prices by seeing this leg go lower. Do you understand? This leg was going lower where? When was this leg going lower? Above the low of Wednesday. Here, we had price just trending lower. Where? Below the close of Wednesday. So, this is a way whereas, once you see this happen, this leg right here is important. So you would take the opening price of, here, like so, right? The opening price of here and this price right here. Once we, get above this swing high, this is the real, a real market structure shift, given the fact that, as I've said, right, we've been trending lower and we had sequential SMT here, right? And we will get back to this, right? There are more things here to be deciphered than, what's already here, what you're seeing right now, but, just to save time. Now, we will look at the real and, easy cracking correlation to see, right? That one was, a bit difficult, took some more time to explain, more time that I would like to use. So here, we have Wednesday and we have Thursday, right? Wednesday, Thursday. So this high right here was what? Wednesday's high. Pretty simple to understand. This is just a, normal SSMT. However, this time, what are we using? This time, we are using the FX triad and comparing it to the index futures triad, right? So here we had price, the dollar, take out Wednesday's high. The S&P 500 failed to take out this low right here, which was formed on Wednesday. So this was a cracking correlation, right? You could directly be, comparing the euro to this, right? Due to the fact that the euro and, of course, the Great British Pound, they should be moving in the same direction, on high probability days with the index futures triad. So here you can see that even though, right, here I was just being bullish, right, I just didn't have, enough time due to the fact that, I was looking at 1 minute charts, 5 minute charts, and I was trying my best not to flunk in front of everyone, right? So I didn't have enough time to be, showing you guys this chart as well, even though, I was looking at that chart, but I have multiple monitors, right? Which is what it's not only what you see, on the screen at times is what I'm looking at. Even right now, I'm looking at different monitors and different screens. So here, right, we had the dollar, the euro, not the dollar, the euro taking out Wednesday's low. This was a cracking correlation. Why was this a cracking correlation? Look in here and listen, this is important, right? This is important. This right here, which I am talking about, this is what you call a direct cracking correlation, right? This one seems invisible to everyone else, but this one causes the market to turn. This one is very explosive, right? So here what are we doing? Let's retrace our steps. We are comparing the FX triad to what? The index futures triad. Ultimately, you can use these alone, but, I always like to get at least the bond market in the mix, right? At least, that's me, but you don't need that. But listen now, right? Whenever you have the US dollar, the euro, and the Great British Pound, right, moving in sync. So here you have the US dollar take this high. Here you have the euro take this low. Here you have the Great British Pound take this low. Now, what do you have here? Failure swings. Do you see where we're getting at? The S&P 500 and the NASDAQ and the Dow, they're moving in tandem. The US dollar, the euro, and the Great British Pound, what are they doing? They're moving in tandem. So here we have a higher high, right? Basically, this is turtle soup. All of this right here is turtle soup. All of this right here is a stop hunt. Stop hunt, stop hunt, stop hunt. Here, what do we have? Failure swing, failure swing, failure swing. Now, right, we remember, if this theory is correct, right, and what do I always say? Which asset usually gives everything off, right? Which asset usually tips its hand? For the index futures, it will be the Dow Jones. For the FX triad, it will be the Great British Pound. And for the interest rate triad, it will be the 5-year, 10-year note. No, the 5-year note, sorry about that. Here, what do we have? And we talked about this before, but you don't even really remember, which you should, right? Here, look. Price falling below the 50% of the range. And here again, what do we have? Price falling below the 50% of the range. And here, what do we have? price failing to fall below the 50% of the range, failing to close as well. Do you see this? This in itself, this is a correct correlation again. How do you know that this is right? Here, the Great British Pound failed to close below this low. Do you see that? The euro closed below this low here. Here, dollar closed above this high. So this in itself as well is a correct correlation because price did not close below the low. Right? But even without even focusing on the closure, just due to the fact that we had turtle soup occurring, between all of the members of the FX triad and failure swings occurring between all of the index futures triad, that in itself is important. Right? You will have people, that are looking for SMT, not even seeing it. They can't see it. Why can't they see it? They don't know about this. They do not know that you should directly be comparing 8 assets, 3 of them from each triad should be mirroring each other. But there should be a opposite correlation, something of a sense which they don't even know exists. So the euro, the pound, and the dollar should be doing what? Taking a high or a low. Right? The index futures triad, S&P 500, NASDAQ, Dow Jones. What should they be doing? What should they be doing? And, this is something that will, usually happen, something that occurs in price action, which I've been getting questions about, like even 2 months ago, but, we need to build upon information, right? We need to make it easy to understand. And, this phenomenon, will occur more times than not on Thursdays. It does happen during other times of the week, right? But it is more, what I would say, prominent. It's more important. It's more explosive. This is what really pushes the market, right? It really gives it a big push, like just as we saw, we saw all of this right here, slow, choppy price action, and then we just had price expand. This is what usually happens, right? So this is direct intermarket sequential SMT, right? The layman, the person who is new will not, know how to differentiate between them. For this, you don't care about the closures. It's literally just, okay, let me look at the index future chart, everything, okay, failure swing, failure swing, failure swing. Then you look here on the FX chart, okay, dollar took this high, euro took this low, Great British Pound took this low. It's time for the market to turn. High speed. Anyways, right, we will, touch upon that more, but time is going by. Right? So here, right, this is the Monday model, right? Whereas we talk about this a lot, right? We always talk about this and you always see this happening. Like, be honest, like how much times have you seen this happen now? Does it fail sometimes? I'd say, yeah, some of the times. But even if you're not, versed in this, you probably won't see it failing more than 30% of the time. And that's just for people who are new. If you actually, use this, focus on this. Could literally be trading Monday alone. I'm not saying that you should, I'm just saying that you could, right? So here, and remember we talked about this. This is what makes Monday expand. Why? When is Monday X? You know, people say, but sometimes it doesn't accumulate. Sometimes, you know, this this happens to create volatility. Remember, where price cracks, it turns. So here we had price doing what? Cracking. We had the S&P 500, right? We had here failure to take this high. Dow, failure to take this high. No, no Dow. NASDAQ, failure to take this high right here, which was what? Friday's high. Then the Dow, we had price closing above this high, which is what caused price to fall. Do you understand? This is what caused, price to fall. What? The cracking correlation between Friday and Monday. Why did Dow fall? That's why. And what happened right here? What is this? Let me see it in the chat. What is this? I don't even want to say it. What am I, showing you? What is this? And remember, when you're using the weekly cycle, you need the 1 hour time frame, right? You got to be focusing on the 1 hour time frame. Yes, this is a precision swing point. Everyone knows. This is a precision swing point. Listen very closely. When you see something like this happening, right, and you're using the correct time frame, the 1 hour time frame, the weekly cycle, there's a cracking correlation between Monday and Friday, or Tuesday and Monday, or Wednesday and Tuesday, or Thursday and Wednesday. If there's a precision swing point, which concludes the, whole move, the top, or, say prices here, you see this precision swing point, what do you look to do? Short. Right? 1 hour time frame, where do you find your entry if you don't want to enter here? You could. Where do you find your entry? You find your entry on the 5-minute time frame. You can use the 15-minute if you want, but ultimately, when you see a precision swing point, whenever there's a cracking correlation between the days of the week, and this is special, right? It has to be a 1 hour precision swing point. Write that down. Weekly cycle, 1 hour precision swing point. Daily cycle, 15-minute precision swing point. 90-minute cycle, 5-minute precision swing point. Right? Right. So, yes, again, this is what caused price to fall. Right? And isn't it crazy? No one who talks about precision swing points. No one. No one. No one has ever talked about this, and people won't even understand. You just be like, they're just going through charts, just trying to find the right one, but they don't know that there's a sequence that this must happen. There's a sequence that it must follow that, and they just won't know. It'll just seem like nonsense to them. Why? No one talks about this. No one ever. It's not like what Michael would say. No one ever talked about gaps before me, and then you can go in a book and find it. When he was like a teenager or something. I don't know, 20 years old, before he even got big. It's not someone can market maker buy models. You can't say that Wyckoff taught this. No one did. No one did. No one did. And people will in the future, I'm pretty sure. Like whenever like I like just stop posting on the internet whenever I'm just like in the group, whenever we, you know, get our shit together. get get rid of, and I think that we're getting rid of most of the leakers, right? Got rid of like, a few of them already, personally, which is good. But yeah, anyways, no one ever talked about this. No one knows what this is. It's simple as that. No one knows where it works or when it works. And here, right, you guys can see that this Monday, right here, right, this Monday is, it occurred right after. Let's show. I want to take all of this off of the chart. Right, this occurred right after the first week of the month, right? So remember, what is this? Right here. Tell me, what is this? This right here, like, what is between Q1 and Q2? That's the true open of the month. Do you see it? I think this is literally elementary stuff, like true week open month. Like you should always be focusing on it, like of course, but this is when it works. Right? This is when it works. Also here, what is this again? This is the 4-hour time frame. You're gonna learn something cool now. And it's literally everything here is based on what? What is this? What is this candle? What is this candle right here? It's a precision swing point. It's a 4-hour precision swing point. Between what? What happened here? This was a cracking correlation as well. Right? But what's within this precision swing point? Let's go down again. Another precision swing point is there. Wow. Really? So there's a 1-hour precision swing point in a 4-hour precision swing point. So you're telling me that I should wait for another precision swing point to form within a higher time frame precision swing point? Of course. It's all fractal. We never thought about it before, did you? Is there a 15-minute precision swing point? Check. We've been here for 45 minutes, and time to see where the liquidity rests. So here, right, whenever we have this, right, we're looking at price, right, and the one that looks the choppiest is the one that we should focus on, because this will give price a reason to reverse due to the fact that it has the clearest, the most clear, is clearest your word? I don't know. It has the most clear buy side and sell side liquidity, right? So this right here is already showing us that we have, volatility coming our way. Right? This right here as well. And remember, in regards to the triads, right, we should always be focusing on, well, in regards to the index futures triad, we should be focusing on the S&P 500 and the NASDAQ mostly, right? Soon, right, we will be, talking about how we can use the Dow, right? There are ways that you can use the Dow to see market moves beforehand, as the Dow will point towards where the market should be going, and then there's a cracking correlation, right? We will talk about that as well. So we have, right, let's look at the S&P 500. We have buy side liquidity here, sell side liquidity here. Is this high probability? No, right? the move that should happen already happened, which was, orchestrated by the Dow. The Nasdaq, what happened? It's within a range. This is not high probability price action, right? So here, what would we wait for? Price to take either side of liquidity or show us, a lower time frame sequential SMT followed by a precision swing point. Do you need the precision swing point? No. A precision swing point could be replaced by a fair value gap SMT fill, basically. Right? So here you can see this line and this line. What am I annotating? Buy side, sell side liquidity. Right? Buy side and sell side liquidity. Just, equal highs and lows. We will be, looking for a cracking correlation. We will be waiting to see how the market will be moving, before CPI. Tomorrow will be, well, I expect you guys to be, focusing on the New York session and seeing how the market reacts, or seeing if there was a significant amount of liquidity left from London which gets pierced. Then is there a sequential S&P after that? Then focus on how price moves. Here, right, you can see that. Let's look at the British pound, right? We have a significant amount of liquidity above this high, right? And we have a significant amount of liquidity below this low, right? US dollar, we have a lot of liquidity here above this high, right? However, we are still range bound, right? Between, let's look at the dollar, between this low and this high, it will be, near to equilibrium, right? But there's liquidity here and liquidity here. So we need to see, price push above either, pools of liquidity or below, which is here, and below here, which a news event, high impact news event will give us, right? That push. But for now, what do? We wait. We'll be updating our charts. You guys already know what to look for, right? But, if there is something, obvious, then of course we will discuss it. And, before going, I just have to share this one last thing. So, you guys already know what a SMT fill is, right? This is another type of cracking correlation. Whereas whenever this happens, right, you will not expect, price to fill the gap right here. Now we're looking at the euro. Wow, this one is going to be long. I'll just make it 50 minutes. I'll just make it 15 minutes. That's it. Then there's this guy asking this one question. I'll just answer it. Look at this guy. Study this in price afterwards, live price action, not just, you can back test and study it, of course, but, right? So here we have this gap being left open. This one was utilized, right? This one right here utilized, and we pushed above these equal highs, right? You can see that. Now let's look at the British pound. Here, there was no gap left. No gap was left. Price just wicked into this, what people would call a quote unquote order block, then continue higher, right? You can see that. Whenever you see something like this happen, right, and price forms a high here, falls, don't expect this gap to be filled. Right? It won't be filled before liquidity on the in the opposite direction, right? Not sell side, but buy side liquidity is ran through. Right? So that's it for today. I think we've been here for around 15 minutes. 15 minutes, which is a long time. So we will be back Wednesday, 8 a.m. sharp. And someone's asking me a question. I will answer it. Last thing is day. Just one SSMT with precision swing point. Yes, you can do that. Just make sure that if you're using the weekly cycle, it's a cracking correlation between days of the week and a 1 hour precision swing point. Right? That's what you should be looking for. Then if you go down, a time frame, the 15-minute or the 5-minute, you just need at least one cracking correlation to be in line with the higher time frame. Right? Then you'll be fine. Please study this. Use proper risk management. Don't be afraid to lose. Don't, get a heart attack when you go in drawdown. Manage your risk properly, and you'll be fine. Definitely, you'll be fine. Don't worry. Think before you trade, and I hope that you have a, wonderful week and a good time studying this, going over this. Go back over the last stream too. That one was good too. Yeah, and we'll be back again 8 a.m. sharp Wednesday. Sharp. That one will be a long one as well. Have a wonderful day.